In this video, I compare two YieldMax ETFs, which are YMAX and BIGY. While YMAX has been around for more than a year, BIGY has been just released in November. YMAX racked up almost $800 million in assets, but BIGY is still struggling to break through 10 million mark. It seems that investors' interest in BIGY has been lackluster at best. Let's find out why. If you're new here, welcome. I'm Andrei and I talk about investing and personal finance on this channel. First, you probably know that YieldMax funds are famous for their outrageously high yields. YMAX yield ranges from 40 to 50% depending on when we look at it. Conversely, BIGY's yield is much smaller at about 12 to 13%. To get to the bottom of it, let's take a look at how YMAX and BIGY construct their portfolios. YMAX is a fund of funds, meaning it holds 29 other YieldMax ETFs. These ETFs are mostly one-stock funds that use covered call strategies. What is a covered call strategy? If you're watching this video, you probably know what that is. It involves selling call options on the underlying portfolio of stocks. By doing so, covered call funds generate premium income, which later gets distributed. But of course, there is a catch. By selling call options, these funds cap their upside. A known issue with covered call funds is that they tend to lose money in bull markets. Likewise, they provide some downside protection, but a very limited one. In other words, covered call funds prevent investors from participating in bull markets and expose them to downside in exchange for income. Where covered call funds may outperform their benchmarks is in a sideways markets, meaning they will get better returns when the stock price goes nowhere. In this case, the covered call funds will generate premium income without capping their upside. YMAX doesn't do covered call strategy directly. It does so indirectly through its fund holdings like TSLY or APLY. One negative thing about YMAX is that it uses equal weighting for its allocations. In other words, YMAX allocates the same equal percent to each fund, which tends to be around 3.5%. The bad thing is that equal weighting punishes winners and rewards losers. If, let's say, TSLY stock price goes down, its allocation in YMAX portfolio decreases down from 3.5%. Conversely, NVDY may go exponentially up. With time, its allocation increases above 3.5%. In this scenario, monthly, YMAX will decrease allocation to NVDY but increase it to TSLY. Many popular index funds tracking S&P 500 or Nasdaq 100 use market capitalization approach, meaning the bigger a given stock gets, the higher its allocation in the fund's portfolio grows. And it's like a momentum investing which rewards winners and punishes losers. And it's in stark contrast to YMAX equal weighting approach. So maybe there's an argument to make that YMAX allocation strategy is suboptimal long term. BIGY is also an actively managed ETF. It targets 12% distribution yield and some capital appreciation long term. Unlike YMAX, BIGY directly invests in a select portfolio of 50 large companies. These companies must have US headquarters or domiciled there. BIGY also requires potential candidates to have enough liquidity in its options contracts. If we look at BIGY's portfolio, we won't see certain big names. Among them are Novo Nordisk or Taiwan Semiconductor Manufacturing Company. These companies are foreign and don't meet BIGY's criteria. Also, BIGY doesn't hold Berkshire Hathaway stock, and it's hard to say why. If you guys know why, please let me know in the comments below. But other than this, you will see all the typical names of some of the largest US stocks. Note that BIGY uses market capitalization to weight its holdings. This is better in my opinion compared to YMAX ETF. The big negative of BIGY is its top-heavy concentration. The top 10 stocks account for 64% of its portfolio. Top-heavy concentration amplifies both losses and gains. So if for some reason its top 10 stocks underperform, they will drag BIGY's performance big time. YMAX, on the other hand, has a smaller concentration by its equal weighting design. Its top 10 holdings account for almost 37%. We can say that YMAX shows better diversification based on this criterion alone. Another thing to keep in mind is that both funds are leaning heavily towards the tech sector. BIGY's allocation to technology stands at over 40%. YMAX does not disclose its sector allocations, but we can deduce that its portfolio is heavily tilted towards tech too. The allocation is probably over 40%. So if big tech underperforms, both YMAX and BIGY will be in trouble. Let's come back to yield and covered call strategy for a second. Both funds use covered call strategy, but there's a big difference between those two. YMAX prioritizes yield, and hence its distribution yield is higher compared to BIGY. YMAX underlying funds write or sell call options that expire in a month or less. For instance, let's take a look at APLY prospectus. It says that its covered calls will have a strike price 0 to 15% above the then current Apple price. While the range is wide, Apple is selling call options pretty close to the then current price. Only this way Apple can generate a large distribution yield that stands at above 20%. Otherwise, you won't get much income if you sell call options at a strike price 10% or more above the current price. This observation correlates with what Apple's prospectus says. It says that its main focus is income and capital appreciation is secondary. By its construction, YMAX distributions tend to fluctuate a lot from one month to another. Here's a chart showing YMAX dividend history. The chart comes from Seeking Alpha. I partner up with them as they're a great tool for investors to research stocks and ETFs. I left a link in the description, so check it out. Anyways, we see that YMAX distributions fluctuate a lot. This is because stock volatility affects YMAX distributions big time. If volatility is low, distributions are low too, and vice versa. On top of it, massive focus on yield amplifies this effect. BIGY is a different animal altogether. Its main goal is a balanced mix of income and capital appreciation. And because BIGY invests in stocks directly, it earns dividends, and that alone contributes some to its yield. Conversely, YMAX doesn't earn any dividends at all, and the reason is because its underlying funds, they don't invest in stocks directly. Instead, they gain long exposure to these companies like Apple or Nvidia via synthetic stock options positions. Second, here's what BIGY states in its prospectus. It sells call options with the goal of participating in market upside. If we look at BIGY's underlying holdings, here's what we see. Its covered call positions tend to have a strike price much farther out than YMAX. For instance, we saw that Apple aggressively shorts call options at strike prices around $230 and $240. This generates high income, but it caps upside if Apple rallies above $230 or $240. Conversely, BIGY also has a covered call position in Apple, but the strike price is at $245 or $255. In other words, BIGY gives more breathing room for it to take part in market rallies. But this comes at the expense of lower distribution yields. The reason is simple. Covered call options with strike price way above the current stock price yield lower income. So it's not surprising that BIGY's yield is much lower compared to YMAX. Also, BIGY's distributions are likely to be less volatile compared to YMAX by its design. Of course, we'll have to wait and see, but this is my take. Let's tackle another important issue for covered call funds, and that is net asset value or NAV erosion. NAV is just fund's equity, and equity is equal to assets minus liabilities. The fund's NAV can change due to many factors, but when it comes to NAV per share, it can only change due to two things, and these are investment gains and losses and distributions. A fund's NAV per share is approximately equal to its stock price. Of course, NAV per share and stock price can deviate here and there, but long term they should be about the same. So a fund's NAV erosion is just one way to say that its stock price goes down. Of course, NAV erosion happens when a fund sustains large investment losses. But in case of covered call funds, this often happens when they distribute more than what they earn in a given period. And this is very typical in a down markets. For instance, in the case of YMAX, its price declined from $20 to $16 per share in the past year. This is a clear sign of NAV erosion. This happened because of price declines of YMAX underlying portfolio and continued distributions. Funds by YieldMax are registered investment companies, and by law they are required to distribute at least 90% of their income to investors. So anytime they generate premium income from selling stock options, they must take and distribute 90% of that income to their shareholders. NAV erosion is a big deal for YieldMax funds. As NAV erosion happens, the available capital per share for the fund starts to shrink. And next are the distributions per share. They also start to shrink for this fund. So the consequence for you as an investor into these funds is that you can't keep all your distributions. You must reinvest at least part of it if you want to keep your yield the same. So the true real yield that you actually get to keep is actually much lower, 2 times or sometimes even more than 2 times lower, depending on which YieldMax fund we're looking at. Also, investors' yield on cost went down over the past year for similar reasons. Yield on cost shows how your yield would change since your initial investment in a fund. We see that it went down for YMAX. Not a good sign. So it's true that YMAX boasts massive distribution yields of 50% plus, but its total returns were actually lower for the past year at about 20–22%. NAV erosion was a big contributing factor for such an outcome. With BIGY, it's too early to tell since it's been out there for less than 3 months, but my take is that it probably will have a lesser degree of NAV erosion compared to YMAX. The reason is because of how BIGY is structured and its goals to have a balanced mix of income and capital appreciation. So this alone will ensure that it will probably show a better recoveries after market downturns. Of course, it remains to be seen, but this is what I think. So, which fund is better? Or a better question is, which investment needs each fund suits best? When it comes to YMAX, it is best suited for investors who are looking for a high yield. YMAX provides a better alternative to one-stock YieldMax ETF since it's more diversified. Still, I see many negatives. Among them is big tilts towards tech and NAV erosion. Also, don't forget that YMAX is very pricey with an expense ratio of 1.28%. According to Morningstar, YMAX is in the most expensive quintile among its peers. Conversely, we have BIGY. It allows investors to enjoy a mix of capital appreciation and income. If we look at asset sizes, YMAX attracted almost $800 million. BIGY's asset size has been stagnating and going nowhere since its inception. That's a big problem for BIGY. If BIGY doesn't grow, there's a high possibility of it imploding and getting shut down. Why is that, we may ask? Well, it seems that BIGY has a lot of competition in its category. Among its rivals are GPQ and QYLD, which offer somewhat comparable yields. But BIGY comes with a much bigger expense ratio at 0.99% compared to 0.35 and 0.61% for GPQ and QYLD respectively. YMAX has been grabbing headlines and investors' attentions with its massive yields. So maybe that's why it managed to build so much assets under its belt. But what about expensive BIGY? Nah, nothing special with tons of competition on the market. So maybe that's why BIGY is struggling. And that is it for this video. I hope it was helpful and you'll be able to make a better and more informed investment decision. In my next video, link here, I talk about other YieldMax ETFs in detail. There's much more to ETF comparisons that I talk about on this channel weekly. So be sure to subscribe and I will see you at the next one. All the best!